I just can't think of a retail IPO that would be more popular than OpenAI. To me, going from 23 billion to 30 billion, I don't even consider it an up round. It's not enough.
If they really have gone from 100 to 150 in less than 6 months, then I can make this conversation really quick. There's no way they should sell. Andreessen Horowitz is the Red Army of the venture industry. What you're basically saying is, Rory, you can win a deal, not because I've grafted for 30 years and returned, frankly, billions of dollars to my investors, but because I'm on a fucking pod. If that sentence is true, if that sentence isn't true, then 100% Mark Andreessen was right all along.
I think Bezos would lay off half his company in a fortnight if it was the right thing. I don't think he even care. Ready to go?
We have so much to discuss this week. It's my favorite show of the week. And we were talking, Rory, about...
It's in the top 2 each week, isn't it? At a minimum,
I would say it's a top 2 show for
always,
sure.
Right?
Yeah, always a top 2. Does that make you feel special now? Yeah.
They say the silver medal is the toughest one in the Olympics, but I don't know about Rory. I'm good with it here. I'm good with
I'll take a silver.
Okay, so we were talking about where we were going to start, Rory, before this, and you were like, I think we should start with OpenAI given the news today. And so, learning from the feedback that we get, I would love to start with you just explaining a little bit about the news that's just come out about OpenAI and their structure, and we can start there.
Sure. I mean, the big news today is OpenAI cut their deal. They cut their deal with Microsoft, and they cut their deal with the attorneys general, the plural of attorney general, of Delaware and California, which means they have been able to implement their restructuring, which means they can raise their capital, which means they are out of the messy, complex trap they had put themselves in all those years ago in terms of their structure, and they've gotten it done. That's the big picture news. There's lots of information one level down about who won, who lost, who got what economics, but that's where we're at. And, it's still got some opposition. Elon can still litigate and say, I don't think you should do that because I gave this money to a charity, but possession is 9/10 of the law, and once the attorneys general have allowed it and they've actually converted, it's a lot harder to unwind. So as of now, as of this morning, as I understand it, OpenAI, there is the charitable foundation, which is now one of the most well-capitalized charitable foundations on the planet. Underneath that, there is the company itself, OpenAI, which is it's a PVC. I can never remember the initials. Basically a for-profit company, but also has to take into account more than just shareholder maximization. I'm sorry, I'm having my dyslexia there, right? So that's the entity that's created, and that's the entity into which you can invest. There are other companies like that. I think Patagonia, for example, has the same status. This is not a crazy thing now. This is not some weird, like the old OpenAI used to have this disclosure. You should regard this as a donation. It can all go to zero. This is a real, honest to goodness American corporation, a different kind of American corporation, but they can go public with this. They've gotten out of the straitjacket. So that's and it's big news. It means, for example, it means an OpenAI IPO is one enormous step closer. Not saying they have to, not saying they will, but big news today.
I'll just throw one thing that jumped out at me on the deal. The overall structure, Microsoft owning 27%, the employees owning 20-something%. The nonprofit owning 20-something%. Those are all roughly what we all expected, right? There's some nuances on how AGI worked. They're a little interesting. But the craziest thing in this deal, because it's unprecedented, I think, in our lifetimes, is OpenAI said that Sam Altman will still have no shares in the combined entity. And at the same time, we've got Elon Musk arguing he deserves $1 trillion pay package so the robots don't kill us, which I think he deserves, okay? I think his VCs will say he deserves it, okay? There is something unimaginable to almost anyone in the world saying he should have $1 trillion pay package, but the scale has to be relevant to the outputs, right? I don't believe it will ensure the robots don't kill us. It's a little crazy. But on the other hand, Elon wants $1 trillion, and everyone was saying show Sam the money when he was fired as CEO over a very long weekend, right? The Night of Knives or whatever was fired by this crazy nonprofit. Everyone had to revolt to bring him back. Fast forward to today, that same nonprofit's in charge still. Now listen, there's been turnover, but it's still sort of charged, and he has no shares. We could hypothesize why. He's pretty transparent. I actually think it gives him, in some ways, more power as well as less power. You can't assail the man for capitalism when his other billion-dollar entities are the ones that let him finish off the McLaren collection. But we've never seen someone own nothing, have we? Like this? Have we ever seen anybody own nothing? It's crazy.
If we just drill down on winners and losers from this structuring change, who are the winners and losers here?
I think the lesson here is a lesson that every attorney knows, which is you often hear this expression when litigators, what's the case worth? In other words, they look at the filings on both sides, and experienced litigators look and go, okay, we got these 3 points, they got those 5 points. In the end, we're going to win on the 3, they're going to win on the 5, this is the way it's going to come out. And then there's a whole load of human drama because humans are like that, and we yell and we scream and we have juries and then typically things settle out for what they're worth, right? This settled out for where the case is worth. Let me tell you what I mean by that, right? Because when you look at the thing, and Jason said, not only no surprise, but no surprise for a long time. Microsoft had a fair amount of leverage. They used it. They got a great deal, right? They put in $13 billion. They got a 10x on their money as of today. They got a lot of AI leverage. They got some going forward AI property rights. They got a significant going forward contract for Azure business if they want it, which we can come back to. Overall, they didn't push it to the point of breaking, but they got pretty much what they were going to. And they still have some rev share, which surprised me. So they got a great deal. Again, I go back to my comment. Microsoft corporate development and lawyers deserve a gold star from their shareholders in a way that, frankly, Microsoft R&D does not. And the proof of this is this morning, Microsoft stock is up nicely. They're like, thank you for the $100 billion we're up. There's 3 big winners. The second big winner is, just a step back, the Charitable Foundation, right? There are some people, again, even today, griping and saying, we did this all for charity. It feels wrong that there's any capitalists involved. And I get that, especially if I'd given the seed money. But stepping back, somehow in the midst of this, we've ended up funding a wonderful $135 billion charitable foundation. That's a significant contribution to whatever good they hopefully will do with that money. And they already made some announcements about AI for medicine. So there's $135 billion out there that's not going into someone's pockets to, buy yachts, boats and football teams. It's actually going to try and solve world's problems. Now, whether they can or not, TBD. But yay, because I would have laughed in 2016. But the people who started OpenAI saying, we want to do good for the world, have at a big picture level succeeded. They built something worth $130 billion, which is a foundation that they can be proud of. So it's a win for them. Obviously, the employees own a third, and now it can get liquid. Yay, them. And then, the remaining, the investors can kind of exhale, get a sigh of relief. SoftBank can put in their $22 billion. And the investors as a group, I think SoftBank will own about 10%, and everyone else will own low single digits. And everyone won, and everyone got roughly what the leverage would make them get. And then the final winner, I just got to say, and I know this a lot, but Brett Taylor just wins the Best Board Chairman of the Year award again for the second time in the last 5 years. He totally won it as board chairman of Twitter, where he jammed that down Elon's throat for $44 billion despite his opposition. And he won here today because he unraveled the mess and set it all up for a win. So it's a really good settlement.
So there's no losers.
Well, the losers would be Elon feels he didn't want any of this to happen, so he's miffed. And the people who think, oh my God, it should all have stayed not for profit. They feel they're losing. There's a lot of that Twitterverse comments today. But pragmatically speaking, if you think about it, Microsoft put $14 billion in here, right? And they've made a 10x, which is a good return, but we'll talk about returns. It's not like it's rapacious relative to the risk they took. No one else was writing OpenAI $1 billion check in 2019. Microsoft did, and they got their return.
So, and the IP for an extended
and the IP,
period.
absolutely.
And
no,
the
so
IP,
So I don't think there's any losers at all. I don't think anyone got much more than they deserved for the risks they took and the work they did.
So I can tell my LPs that the little 6% stake deal I'm doing today is okay because here's look at OpenAI. I don't need to get double digits. Point to this one. Don't beat me up on the double digits.
Totally. No, exactly. And you're right, Jason. It just shows rules of thumb are made to be broken. 90% of the time, your ownership target is a really meaningful metric and it should run your business on it. And, 10%, 1% of the time, who the hell cares? 1% of the biggest company on the planet is $5 billion. There you go.
The one micro thought I just thought was, it's very, there's all the circular financing, who NVIDIA giving them money, AMD giving them 10% of the company, Oracle raising an unprecedented amount of debt.
Yeah.
So what I mean is, I don't know how much equity OpenAI needs, but it seems to me, if they're coming up on being the first $1 trillion startup and more, if they could IPO at $2 trillion, which is crazy by any historical, so is a CEO with no stock, maybe they can raise another 200 billion, right? I mean, at least in theory, that's a lot of capital to access. But my point is, this unlocks maybe 4 times more equity for them, potentially, if the public markets are different than the private, because of the potential valuation they could IPO. They may need that. They may need an extra 200 billion to go the distance.
I think that's an excellent point, Jason. And it means that there's one more set of winners here. All those people who stock popped because they have a bullshit promise from OpenAI to buy a whole bunch of their stuff in the future with money OpenAI didn't have, now at least can say they can go get that money. As you know, I'm skeptical that Oracle will collect the last dollar of that cloud contract, but at least you can now say hand on heart, the customer, OpenAI, now has a sensible corporate structure. They obviously have an amazing business. And if they need to raise another 100 billion, it's not like crazy anymore. It's just banking and math. So you're exactly right. This thing may fail for, there may be business issues around, return on thing, but we're out of the stupid corporate structure getting in the way of everything stage of business.
I just can't think of a retail IPO that would be more popular than OpenAI, right? Just bringing everyone out of the woodwork to put a little bit of their life savings to do it, to ignore even if the valuation makes no sense. This would have to be the most popular retail IPO of all time, right?
Yes, you're exactly, and it's doable. Yeah, I mean, people aren't going to be reading the prospectus and saying maybe we won't make profits. They're not going to be reading the thing about $250 billion of cloud commits to third parties. They're just going to be, let me get some of that OpenAI, right? I think it would be interesting, actually, to your point, it'd be interesting to check on the secondary valuation pop today for OpenAI trades. I mean, because right now, the weird thing right now is SoftBank is closing 2 separate deals right now. They're closing their roughly 300 billion pre-direct investment, and they're also doing a share buyback from some existing employees at 500 billion. So, literally, you have the same security trading at 2 different prices. And I think that's true for other investors too. They've locked in the earlier price. When the other investors, I think Tribe is in this too, when they committed to OpenAI a while back, they said, hey, we'll give you money at 300 billion, but you got to get your conversion done first. So now that the conversion's done, they're going to put the money in, but they've already had a markup before the money. Oh my God, they've had a markup before the money's gone in, right? Because SoftBank is marking itself up by doing business at 500 billion in a secondary, right? So literally you're going to wire money at 200 billion or 300 billion, whatever the number is. And then next day you can say, hand on heart, current valuation of this is 500 billion. So there you go. You're 40% IRR in an hour.
Do you think there'll be $1 trillion company in 2026?
On the current trajectory, maybe all I can answer is on the current trajectory and without the euphoria Jason mentioned, it's probably 2 years. Because, you do get some attenuation of growth at scale. And at the current thing, at 500 billion and 12 billion, let's call them boring GAAP revenues rather than ARR. It's kind of, 40 times GAAP. And if it's 20 billion and 25 times ARR run rate. So my guess is it would take 2 years in the normal course, but you might see that euphoria moment, but it's not crazy. It's not like it's never going to happen. It's within the trajectory. It's within the strike zone. If anything like the current growth rate continues, if it slows, as a reminder, when you're trading, and we saw this in 21, if you're trading at 40 times revenues and your growth rate slows, it's nasty and you fall sheer. But right now they're growing, so they can get it.
I would love a $2 trillion IPO. That sounds great.
Anchor from here. Actually, the interesting question will be the dynamics of the negotiation. Again, when you have master corporate financier like Taylor and Sam Altman on you, it'll be fun to watch the bankers beg for that. They might pretty much do it for half nothing just to be on the biggest IPO of all times. I think technically Saudi Aramco had a kind of a couple of $1 trillion market cap, but nobody really cares. Let's get real. It's an oil company in Saudi Arabia. This would be one for the ages, and I think every banker on the planet will be making decks as we speak and calling on Mr. Altman and Mr. Taylor.
Dude, you'd do it for free for the credit.
You probably would.
Yeah,
Yeah.
no doubt. Is there anything on OpenAI that we haven't covered that we should cover, do you think? The browser, the RSUs, anything that you're like, have to cover that?
I mean, it's all second order stuff. We can come back to it if we have time, but I don't know if it's... I mean, that's the big story. They're free.
You know, the only thing that's mildly interested in the browser is just, I'm just waiting to see, unlike Sora and such, will the world really care? I just wonder how many, it's just tough to keep track of how many stories tech, VCs, and X create. It's not that it's not interesting, right? I mean, obviously the browser is where we live a lot of our lives, but it could be like MCP. It could end up being interesting, but not really the game changer that VCs and others think it'll be. We'll just see. I don't know. Right?
Yeah.
I don't know that it will. The average consumer will find it a game changer to find a new browser. Rather than type ChatGPT into their browser and get enough memory. We'll just see whether they really want it to pick its Spotify selections for us. I just don't know if it's a game changer or more of a land grab, and so we will just see.
Okay, we're going to talk about Andreessen's new funds. Andreessen dominates so much of the venture microphone today. $10 billion split across $6 billion in growth, $1.5 billion in AI apps, $1.5 billion in AI infra, $1 billion in defense. My word, what a big raise. I would love to understand, is this just a new normal of General Catalyst and Lightspeed and the mega platforms raising like this? Is this different? How did you analyze this news?
Honestly, I thought they were small. And what I mean is, I didn't think it was small until I saw the breakdown of the funds, right? At first, when we talked about this before, I'm like, 10 billion, that's unprecedented, right? But when I look at that in the new Sequoia fund, $200 million Sequoia seed fund, that's not that big compared to 20 VC. What's the 20 VCs? 150 out of 400 or something, right?
125, yeah.
Yeah, and Rory's more A and B, but it's not 200 million doesn't really get you out of bed at scale. And then 1.5 billion for AI apps when you're investing in 11 labs and friends and Replit doesn't really seem to get you very far. The seed funds and the AI fund for Sequoia and Andreessen were smaller than I would have expected in today's insane world, where even 50 million at a YC demo day could be a low valuation, right?
Wasn't expecting that. I thought look, step back. Is it the new normal? Yes. It is the business model that Andreessen and a couple of other firms have brilliantly pursued. This is the world we live in today, and as investors, we'll live in for the next 4 to 5 years, right? I mean, somewhere down the line, you'll either have it works over across a cycle, and then this will be the norm forever. And you could envisage a world where this is a little like, where venture becomes more like investment banking, where there's Goldman Sachs, JP Morgan, and the rest of us are boutique players, right? Or the other thing that could happen is the returns from the bigger funds are slightly disappointing and kind of there's a little bit of a tilt back to more mid and small cap ventures. But this is the dominant modality today. This is what top dog venture investing looks like. This kind of scale, this kind of dollars at work, and there's 4 or 5 other firms doing this.
Is there any excuse that I can't compete with Sequoia? I mean, scale can outbid them. I think you can compete with a $200 million seed fund or a 1.5 billion AB fund. I think you can compete.
I agree. The sentence, I can't compete at a seed with Andreessen because of check size, doesn't make sense except in one very derivative way, right? Because I agree. At the end of the day, if someone's raising 10 million and you have 10 million, the other guy has 10 million, end of, right? There could be there's one of two arguments against what you're saying, though, right? Because there's two ways in which the fact that one checkbook comes 10 out of, let's just pick it how, one checkbook comes 10 out of a $400 million fund, and one checkbook comes 10 out of a $10 billion Colossus, right? Let's just say there's two ways in which the Colossus has an advantage. The first is they can literally decide they're not pricing this round, they're buying an option on the next round. If Harry's trying to make his money on seed and they're simply trying to set themselves to make the money on the B, they can by definition pay a higher price because any option always trades higher than the intrinsic value of the asset in question by virtue of the time value. So they can pay a quote unquote a stupid price, right? Because they have a different model. And then the second way they can win, and I'm really internalizing this now, is the wall of news, right? At the end of the day, when you have a $10 billion fund, you always have shit going on. You don't talk about your bad stuff, but provided you're modestly competent, and these guys are far beyond modestly competent, they're extraordinarily competent, you always have some good news in the portfolio, right? You always have exciting things. You're probably going to be in some winners. So I
don't buy the wall of news anymore.
What? Okay.
I'll tell you why I don't buy a wall. I've learned this first from Dr. Harry Stebbings, and now I've learned it others, okay? Look, Harry's in some great investments that he quietly but relentlessly reminds us of the complexities and
Totally.
the Mercors.
And
However he says it with his British accent. How do you say Mercor in British? Mercor. He elongates the vowel or something like that, right? And he tells us all the great stories. What I'm saying is you can get coverage. You don't have to write $10 million checks to be the with participation fund guy. You really don't. You don't. You could write Scale could do 50 deals if you wanted with participation from Rory from Scale, who we love from the pod. So just the option thing's a bigger deal. I just wonder if a $200 million seed fund at Sequoia, how many options can you afford before your whole fund is options, right? That's the question.
The one thing I will say is the with participation thing does not work for publications. And this is very in the weeds and granular. With participation, you playing in rounds with smaller checks does not work unless you have an existing brand. For random tier 2, tier 3 firm, if you were to do with participation, no, the tech crunches, the big brands.
At the end of the fifth paragraph?
No, honestly, they don't. They really don't, Jason. And so yes, we do.
Rory has a following now after this pod. He's got a pretty big following.
Rory now would be.
Yeah.
Even if I did, which
I'm
I
not
would
kidding.
Stop. It makes me cringe. But even if I did, actually, you'd be proving my point, which is it's not because, what you're basically saying is that what you're basically saying is, Rory, you can win a deal, not because I've grafted for 30 years and returned, frankly, billions of dollars to my investors, but because I'm on a fucking pod. If that sentence is true, let me finish. If that sentence isn't true, then 100% Mark Andreessen was right all along. And he said, it's not, I don't think in the end investing is a media business, but I do believe that, and I'm going to give them enormous credit. I admire people who pull off strategy, articulate a strategy and pull it off. They tilted the table with their media strategy. And, here I am on this podcast in my little tiny humble way trying to say, okay, this is the new game. Right. So I do disagree with you, Jason. I think the wall of sound is a combination of the 10 billion and the media presence they generate and all things. I think at the margin, the bigger funds are harder to beat. Right. And you just have to say that it's not by any means impossible. But what I'm saying is, I think Andreessen, I think this $10 billion raise, and I think, by the way, the structure of it actually also makes sense, the 3 different individual funds and then the growth fund. And it makes sense, I think, both for structural investing reasons and probably also for human capital management reasons. You can give your chief lieutenants each a little fiefdom where they can feel in charge, which is a good way to keep them. I think the strategy works. And as I said, provided the long-term returns are there, in terms of tilting the field of play in their favor, I think it's been successful.
I would argue actually that there is massive advantages to them. I get you, Jason. We've got $275 million for a Series A fund versus their 1.5. That is a lot more money for management fees to pay great people. That is a lot more carry. That is a lot nicer offices, which founders do get wowed by. Like it or not, they get wowed by it. That is a lot more events to host where you can have serendipity. There are a lot more things, I think, that Scale and AUM buys that do increase your chance.
One of my favorite expressions is from the Russian Red Army, which is quantity has a quality all its own. In other words, when you want to take Berlin, at some point what you do is you just get 2 million people willing to die and you march them forward, right? And, Andreessen Horowitz is the Red Army of the venture industry now. They got the 10 billion and they're going to march it forward, right?
But it's not, listen, we can move on. Here's my point you guys didn't address. It's not, of course it's 10 billion. It's 10 billion of 30% carry and 10 billion of 2% fees and 10 billion of all this. But when you break apart the funds, I really don't think Sequoia having 200 million is that different than what Harry has, and I don't
No, I
think
agree with that.
one and a
I
half
totally agree with
billion
that.
for their AI apps funds. I think it's only twice as scale. So I just don't think, like AirCover, it's an excuse. You have to work twice as hard as they do. That sounds right. You should have to work about twice as hard, and but it's not really 10 million and a billion, right? When you break the funds up, right?
I agree with that. You do have to work twice as hard. I totally agree with that. But as a comment here, again, I mean, hard nose is, as a comment, the definition of a good strategy is if you have a strategy that doesn't allow you to have to work that hard, right? And therefore, by definition, having 10 billion is a good strategy. I mean, I think the interesting thing, and we said this before, but my big aha is this: the only people for whom this might be a net negative is the LP investors. And as I say, and we don't know that yet. Maybe it'll be a wildly successful strategy, in which case it will run the table. Or maybe it'll be modestly successful, in which case in 5 or 7 years, the LPs will start going, hey, you know that late stage fund, it gives me a good return, but it's 12, 13%, and maybe I can get that in the markets now that there's more IPOs. Maybe we should just throttle back our allocation. We love the early stage stuff, some version of that. But until something like that happens, for every other player in the market, having 10 billion is better than not having 10 billion, right? So that's what the game is.
I do also think for everyone listening, they don't often understand the stapling that is required to be in these funds, which is if you're an LP and you want to be in the early stage fund, you will very often with top tier brands, have to put in 2 times that into another fund to get that $1 in the other. And you don't get your pick of which fund. Very often you have to be across all of them.
Yes, and when you see that, you realize that intuitively, leaders of venture firms understand the concept of bundling at their core, right? Bundling and rent extraction is fully understood.
Jason, you said about this company, Mercor, I think it was. I think it might be a 20 VC company, to be fair. But they announced yesterday they've raised $350 million at a $10 billion valuation, led by the person who led their last round at $2 billion only 8 months ago, which is Felicis. Now, this company has gone to 500 million in revenue faster than anyone else, I believe, in history. I think it was 17 months. Also, again, this is not bias. I hate freaking bias shows. I sometimes listen to them. A lot of people say it's not real revenue, it's GMV. I wanted to hear, how did you guys feel about this round? The speed of revenue acceleration, if it's real revenue. I want your thoughts.
It is quote unquote real revenue, right? In the sense of it's, they ship things, they get paid, right? GAAP requires you to book it as revenue. Maybe step back and give people some context. Merc, what they do is they provide humans with specialist knowledge and their customers are the large foundation model companies. And what they do is they bring this human talent to bear to help the foundation model companies train the models by providing human feedback. People would have heard RLHF, reinforcement learning through human feedback. These are the humans that do that, right? So if I'm OpenAI and I want to, quote, teach my latest model how to do advanced math, what I need is a whole bunch of doctorates and PhDs who understand math that are available to pose questions to the model, judge model questions, give feedback on which answer is correct, which answer is not. So by doing that, you effectively, by giving this human feedback, I think of it as you pound the model into submission where it eventually says, okay, I've learned this shit, by adjusting the weights. That's what's going on here, right? It's an astonishing amount of, we think of this all as happening in NVIDIA GPU chips. There's an astonishing amount of human training that is required to make these models work, right? So that's kind of the market these guys are playing into, right? Scale AI, which was partially acquired by Meta, is in the same broad market. These guys Mercor has done an amazing job because 5 years ago, as Jason said, I love the expression, 5 years ago, we were labeling cats, right? And, you had people often overseas charged with labeling cats and not getting a lot of money. I think Mercor realized that the market today is not labeling cats. It's in fact answering complex physics questions, math questions, bio questions, because the models know how to label cats now. And what they need to do is the outer edges of human knowledge. So it's a very different set of humans that you need. And Mercor did an amazing job of assembling all these kind of high-end folks and making that product available to the model companies to do it. So that's kind of what they do. And in that context, the growth, quote, isn't surprising. Because if you think about it, these model companies have grown faster than any company in human history. they're spending $400 billion on compute. They're probably spending $4 billion on RLHF, and they were spending zero 5 years ago. It's an explosive growth market. So, it didn't happen in a vacuum. This happened because their customers want their stuff.
I actually obviously spent quite a lot of time in the market, which will surprise you, Rory, to hear that I've been thinking about markets more deeply. But it all started with like talent acquisition. If you got the talent and could provide it, fantastic, we'll pay you. That's pillar one. Pillar two is get the talent, number one. Now we want data acquisition, which is you provide it to us, not we extract it. You provide it to us, and then you measure the quality of it too. That's the second pillar. And now we're adding the third pillar, which is the implementation layer, which is we now expect you to not only do those first two, but we expect you to implement it efficiently and make sure our models get off the ground more effectively. And with that, you also see increased pricing and the willingness to spend much, much more from the model providers. The other thing I will say is you have concentration of buyer unlike any other industry. Two buyers are 50% plus of every one of these labeling providers' revenue. So there is real revenue concentration there. It's high quality customers, but you do have that dynamic as well.
Agreed. And that was well put, because it actually it makes it an interesting question from an investing perspective, because on the one hand, there's nothing better than a customer who's got an urgent and who's well funded. We just agreed they're well funded. Who's got an urgent and compelling need to get a bunch of stuff done that you can help them with, and wants you to grow with them. And what you're saying is you're exactly right. OpenAI and all these people, 5 years ago they had simple requests. The more the complexity goes up, the more you meet that complexity as a vendor, and Mercor has done that in spades, the more revenue they're going to give you. So they're going to be shoveling money at you because you're solving their problems. They got other shit to be solving. They don't need to be thinking about this. Mr. Mercor, if you can make this go away and get me, 500 doctors and this data and this answer and integrate it to our system, I will pay you money because money I have in spades, time I don't got.
For sure, but I've got to imagine, you guys, and especially Harry would know better than me, I don't think it's it may not be stress-free. I have a portfolio company that was doing a vaguely similar attached to a large AI business model where the contract was growing to 8 figures. Okay, that renewal was stressful AF.
Yes.
Nobody. Once you get to 8 figures, okay. I know these guys have more money and time than engineers, but there's a point where you turn around and you say maybe we should do a little. OpenAI is building its own chips. I'm not saying this happened at Mercor or Scale. I'm just saying it's Harry's point of having to radically go up the value chain is both more revenue but more stress, because I don't think anyone's just shoveling money at Datadog and Mercor without even thinking about the margins.
I totally agree. And that's what makes the venture fun and challenging, is that you've got one, and I mean, you look at the checklist and you have one enormous positive, great big honking market growing like a weed, you're exploding. And then you got 2 negatives. The first is your margin profile is not amazing because the gross revenue is 500 million, but you give 70% of it to the doctors and the mathematicians who don't know, or whatever it is, some percentage. I'm not going to speculate. And then the second fact you have against you is massive customer concentration. And at some point they're going to say, I'm giving you 200 billion, which means you're making 30% on that 60 million. Hell, maybe you do it for 40. Right. So from a long-term value extraction, I prefer to be, you prefer to be OpenAI and have 800 million customers than to be Mercor and have 2. That when you look at those positives and negative, what you say to yourself is, this is fundamentally a bet that the AI CapEx train will keep running for 2 or 3 or 4 more years. If the AI CapEx train slows down and OpenAI is only going
enough? Is 2 to 3 years enough?
Well, whatever. At least you're right, Jason. At least 3 to 5 years. In other words, that it's a permanent new thing at growth, because OpenAI is not going to focus on getting efficient until it's dealt with hypergrowth. So as long as it's not getting efficient, you probably can lean in. If it slows down, then the positives, which is the growth rate, goes away, and then all the negatives come back to bite you. So if you were to say to a public or a hedge fund guy, find me a bet that had the maximum exposure to hyper AI CapEx growth, this would be, right up there with NVIDIA. I say, I like this risk, man.
If you're doing this at 10 billion, what are you underwriting it to? What does that maths look like?
I mean, as we're going to discuss later, you should be buying anything to a 3x. So you got to be 30 billion to make it worth your while, and 30 billion. And, I'm just doing the math in my head at even at 5x revenues, my God, that's 6 billion. You know, you're underwriting a lot of training data. You know, right? That's the sobering thing.
In the short term, though,
Yeah.
if they're at 500 million at 10 billion, growing at an unprecedented
You're so
rate,
like Jason.
we're all ignoring gross margins in 2025, it's only 20 times revenue. So like, it doesn't seem, this is where actually we're seeing revenue compression, right? Which we talked about with Cliff and others. He doesn't like the revenue compression at Canva, right? Where this 20x ARR, was your last deal lower than that, Harry and Rory? Higher or lower than 20x ARR, the last deal you did?
It was higher. And
Higher.
I'll admit, and Jason, you're exactly right. Actually said something else that was really insightful. Your comment is, there's two modes of thinking about an investment. And I think it's really insightful, Jason. There's one mode that says, pencil me out the next 5 years. How do I think end state? What market do I have? Right? And then there's the other mode, and therefore, what return are you underwriting? And I think if you assume 5 times revenue and you want to be at 3x, you're underwriting 30 billion, which means 6 billion in training revenue, which makes a man pause. On the other hand, you can say it's growing 5x, and if the multiple just stays constant and it grows 5x for another year, I'll be 5x up. Right? And in fact, that's just what happened on the last round. It was at 2 billion, I don't know, at 100 million, and now it's at 10 billion at 500 million. So it's kind of the near-in revenue traction is saying to everyone, as long as this keeps happening, you can grow it really quickly. Because what? You look back now, and because, we're talking about is it worth 10 billion, but go back, give them credit. You now look at the 2 billion that somebody paid 6-7 months ago. And you're like, oh my God, that seems cheap, because you're like 500 million already. So this is when high growth happens, it's tempting, and it often pays to lean into that growth. And yeah, you very quickly, just like I think, the Anthropic round at 67 billion earlier this year now looks dirt cheap. If the hyper growth comes at the size of growth we're dealing with now, which is not, to your point, Jason, trouble, double. It's, I don't know what the word is, but fipple, deckle. I don't know, right? If you grow 5 or 7x, you can grow into almost anything. So this whole thing, top to bottom, is one big ass bet on AI, CapEx, hypergrowth. And as long as it keeps happening, I don't want to quote Chuck Prince, but we all know the quote.
No, we don't.
Oh, you were young then, Harry. Chuck Prince famously said in 2007 at Citigroup, as some version of, as long as the band keeps playing, you got to stay on the floor and keep dancing. And it turns out he should have stepped down and not danced anymore, obviously, given the way 2008 happened. But in other words, it's the quote of, when things are working, everyone just tends to lean in.
Well, when things are working, everyone just tends to lean in, baby. Ramp is a fundraising machine. Guys, they raise every few months.
Yeah.
It's nuts. Reports that they're raising a new round at a $30 billion valuation, reportedly. What are they doing with all the money? Do they need it? Is this a game of customer acquisition and brand? Do we just do rounds now to continuously stay relevant, to Jason's point?
We talked about this a few weeks ago on the last raise, and I have nothing to say that I feel like I just had these comments. Yeah, there does appear to be a combination of, insane demand for the stock, an ability to use that to create this aura of inevitability. And, to some extent, as I remind you, this is more than most companies. This is one where constant growth requires lots of capital, because you're in a capital advancing business. So you probably have, every dollar you add of revenue takes $5 of capital, because you've got to finance purchases, because you're effectively recreating Amex. So it may well be, I haven't seen the numbers, that there's a larger demand for capital here than the average deal. Right, and I'm sure they can leverage some of that. But if you're going to $1 billion, you probably have a $5 billion balance sheet. I remember doing the math at one point in time. So if someone's lending you $4 billion of that, they're probably going to want a $1 billion equity cushion.
Going from 23 billion to 30 billion, I don't even consider it an up round. It's not enough. No, let's say I was a seed investor. I've probably had a token of dilution. Okay, let's imagine I'm down to 2%, which would be great. I have a $400 million position at the last round. Right now, it's worth 480 million with dilution after this next round. It's a lot, but it's not doubling my position like a classic round is. These little rounds, 22, 25, 30. And then with a lot of, maybe not at ramp, but with a lot of AI companies, a lot of dilution, or a lot of others, right? You could see 10% annual dilution in these companies or more. You might go from 22 to 30 and have the same price per share. It's possible, right? I just don't really care about these micro step ups that look great. You're like 30 billion. Well, if the last round was at 10, impressive, right? If the last round's at 3, like Mercor, very impressive. Here I'm like, meh.
That's cute, but I'm pushing back.
For real.
No, I know it's for real. I know you. But comment here, another spin on what you're saying is, with the exception of the new AI companies, that probably is the kind of IRR you should expect to get in a mature growth private company, right? Remember, one of my insights over the last, sometimes I just realize the obvious, is that there's really, there's early and late stage venture. And then there's venture for companies that already could comfortably be public. And I think we need a different word for that. It's not even late stage. It's private as public, right? Ramp could just as easily be a mid-cap stock at this point in time, public, right? And you don't expect mid-cap stocks to gap up 3x in a year. You expect, the overall market will go up by 11. The best companies grow 30, 40% year on year. So I look at this and I go, there's no reason to assume that the return to the stock should be different just because it's held in a different corporate structure. The company is the company independent of it's public or private. So I think, and the reason I mention this at such pedantic length is I think as you think about these super late growth fund things, the return they will realistically get, absent the AI lift, is some version of what was the small cap, high growth public market return. Right. So for those guys, because you're going in, Jason, with your venture rule of thumb. Right. And even on let's call it a late stage company doing 50 million, going to 100 million, it should be that 2-3x step up, financing event to financing event. When you're doing $1 billion, you're near profitable, you should be public. You're going to see these much smaller percentage step ups because you're just you really are a different asset class. Your public stocks hiding in private. Which is why, the Stripe's most recent change was from 91 to 110. It's the same kind of thing.
Right, but you just said we're still underwriting. Harry asked you what we're underwriting to. You said at least 3x. So if I'm underwriting to 3x and I did the last round at ramp at 23, meh. Like it's not really getting me to my 3x.
No, but Jason, you are, dare I say it, confusing on your pronouns, right? And let me tell you what I mean by that. You said we're underwriting, or you're underwriting to a 3. I'm trying to underwrite to a 3x. If you're running money at doing companies at 30 billion pre, you're probably not underwriting to an overall 3x on your fund. Now, you might get, let's be fair, the most iconic company of its generation, OpenAI, will give you a 10x, but I don't think you are underwriting to a 3x when you're doing ultra late stage $1 billion revenue run rate, $30 billion valuations. You're definitely not underwriting to a 30% IRR, right? So this is what you get. Again, go back to, there's no reason to assume that just because the companies are still private versus public, that you should get more return than you would have gotten if they're public. And we know
I'm with you.
Yeah.
Well, listen, my only meta point is, and Harry's made this in the early days, like the massive dilution at Anthropic and others, right?
Totally.
I'm just less excited. I found that things that move the needle for my little portfolio, some of these headline rounds don't always do it. Like it's not always that simple, right? It could be years have gone by. There could be a massive increases to the round, massive dilution. You might have forgotten that the last round was pretty high too, back in 2021. Like you might even be flat or down. It looks great, but they're not always as sexy for the IRR or the markup as you might expect. That's all.
By the way, I totally agree with that. And I think that's because you're busy trying to turn, 10 million into 100 million or 200 million. But there's someone else out there who is very happy to turn $1 billion into 2 billion. Very happy indeed. And it's going to make more money than you, just to make it even sadder, dude. Right? Way more money.
And keeping your IRR, trying to keep your IRR above 40% is not easy on later in life of the fund. It gets really hard, right?
Agreed. But for those, again, I go back to, and for those guys, a different game. So yeah, the aha is, to me, the two biggest changes of the last 3 to 5 years have been the advent of what's happening in AI and the transformation of the late stage and IPO marketplace to this ultra late stage where companies are way beyond the IPO threshold and still private. Those are the biggest two changes in the game.
I completely agree. And on the second, I go back to actually Jason's point on the modest size of the Andreessen funds. Because when you take the $6 billion growth fund minus fees, you're at 4.8. You've got $2,200 million checks. It's not that much. It actually feels very reasonable in terms of size.
To their credit, in that chart that went around, they did do a good job of recycling.
Yes.
Wow,
They did an excellent job of recycling.
Yes. And recycling is good.
So we can assume they get the full 6 out, but fair point. It's not a lot of checks.
David George is very, very good. I'm always impressed by him. I want to move to spray and pray. There's different models of venture. You can be concentrated or you can be spray and pray. Spray and pray, for those that don't know, is obviously having a broadly diversified portfolio, investing in lots of different companies rather than few with more money. There's always a question of, does spray and pray work? There was some data released by Carter. What did the data say, and how do we think about spray and pray today?
I disagree. I read the data. I also read, Jason, the blog post on SaaSter, and I think your characterization of spray and pray is wrong. To be very direct, I think the data was awesome. Let's start back with the comment. The Carter data was awesome and very pleasing. Stepping up, what it told people, for listeners, is they looked at all 547 2018 Series B investments, and then they did a histogram of where they come out in less than a 1x, 1 to a 2x.
Oh, that was Series B.
So 547, and then 18% of them greater than a 5x, about 10% of them greater than a 10x, and one deal, Figma, returned 100x, right? And that's a pretty sizable chunk of information. What's it telling you, right? And, I found it really interesting because, in fact, we typically do A's and B's. And I was very happy, actually, by the way. It was exactly what the distribution for our fund model we think has to be, which is 30%. They were actually 35. We would have said 30, less than a 1x. We do wider buckets, 1 to 5x, 50%. They broke that into 2 buckets, and greater than a 5x, 20%. So the distributions on 547 deals match pretty much what we're saying, right? That's a long answer. So if you hit those 3 buckets correctly, the blended return, I know it from our fund model, is 3.7x gross, 3x net to the LP, right? So if you look at that business, if you look at all those things and you get you get enough slots in the buckets, right? In each of the buckets, the good buckets, the 5x bucket and the 10x bucket, you end up with a 3x net to the LP. So the first piece of good news is, if you do it right, the return was available to you. The interesting thing is, to your point, is the right strategy spray and pay? And I don't think that's what it said. That's why I was jumping back on it. I don't think that's what it said. I mean, I think it says, you got to pick very carefully, because obviously if you do a lot of deals, but I mean, Jason picked on this, looking at the same data, Jason picked on the negative, which is 2/3 of all deals are less than a 2x. Which means they just don't help. Correct, Jason? That was the point you made in the blog, right?
Yes.
And what it says is picking is so important, because if
did it say that?
No, your blog didn't say that, but I think the data says that.
But first of all, you're right. I mean, to me, the data was shocking to someone that is a concentrated investor, because this is scary risk for me. But it did blend out to 3x net, plenty good, right? So you're right. And but at Series B, everyone thinks they're a great picker, don't they? This isn't pre-seed. Everyone's a great picker at Series B, right? So does everyone have the same logarithmic distribution across these deals, or I don't know.
No, they probably don't. I mean, I wouldn't say everyone. I'd say 3 things. Everyone thinks they're a great picker. Not everyone is a great picker. But the third sentence is, you have to be a great picker to win, right? Because if you look, I was thinking at it, you kind of articulated those 2 strategies. You can, again, faced with this opportunity set of 547 Series Bs in 1 year, right? It's a very clear data point, right? I think if you don't pick, if you're not a good picker, you will end up with more. Remember, to Jason's did a different set of buckets, but his buckets are more scary. He said 2/3 of all these deals are less than a 2x. If you skew, and that's on average, if you skew, instead of 66%, if you skew 75, 80% in that less than 2x bucket, your math doesn't work. And it's not that hard to be that bad, because on average it's 66%, is my point. Right? It requires a fair amount of discipline and picking to pull this off. I don't think the spray and pay strategy would work here. It might work at seed. I'm not as familiar with seed. But here, the cost of spraying just gets too high. The picking doesn't work. The only way it doesn't, and I can see Harry doing his I don't agree face, is I think there's actually three approaches. There's picking, there's spraying, and then the third one, which is someone big like Andreessen can do, which is optioning. Right? You can spray if you have if you're just doing options. But if you spray and that's the only way you make your money, the probability of being wrong is just too high.
So that's exactly what I was going to say, which is actually in reference to an amazing graph that was released a month or so ago about seed bets by multi-stage firms. And Andreessen did 72 seed bets compared to Score in number 2 at 27. And exactly to your point there, Rory, you said you can't win without being a great picker. I'm not saying Andreessen are not great pickers. I'm not saying anything against them, but you can if you have 72
Agreed.
option bets.
Agreed. There are three strategies. There's spraying, picking, and optioning. Right. And to do the optioning strategy, and because the beauty about when you can option, you can afford to spray more. Optioning allows you to spray more. Right. You're exactly right. No, I think it's super clear at every stage. And again, it goes back to structurally. I mean, once upon a time, you thought seed was all about option value and anything beyond that wasn't. Because we're dealing with gargantuan sums of money, it is now plausible that for some people, A's and B's are partially options. And really, if you're going to deploy 200 million in the growth round, you don't want to be totally slipshod at the A and the B, but you can think of it as more option value, right? And that's absolutely a superpower that a wall of money gives you, right? I can't afford to do that because most of my money goes in on my initial round. At most, 50, 60% comes in follow-ons. So I can't afford to be wrong on 2/3 of my money to be right on 1/3. That's not going to make me $1. Right? So poor me, I'm stuck having to pick.
Does the ever-expanding outcome scenarios that we're seeing today, before $30 billion was an insane valuation for a company. Now we're kind of like, meh, with Ramp, 10 billion with Mercor, and we're not blown away by it. The outcome sizes are getting so much bigger. Does that not favor a spray strategy? Because all that you need to do if you're early is just get into the winners. Who cares? Not who cares, but 500K or 2 million, it doesn't matter. Spray the 500Ks because the only thing that matters is Mercor and Ramp and everyone are in yours.
No, because what you're doing is you're taking a plausible theory and extrapolating to the point where it no longer holds true. You can spray as much as your bankroll will allow you. The more bankroll you have to build up option value, step back. You could be talking about two things, Harry, and you got to break them apart. Are you saying simply spray because I'm not going to make my money on follow-ons, but it's the seed argument. I have to be in the very best deal and I have to cover wide versus concentrated to do that. Mm-hmm. Right? And that's one thread. And then the separate thread would be how much easier is the spray constraint if I also have option value at the back end? Right? And that's easier. There's no doubt. The more option value, let's agree the following. The more option value you have at the back end, because you have a $10 trillion fund, the easier it is to spray because you can amortize the cost of the losses over the one winner. Provided you get to stick 500 billion in the winner, the rest is noise.
But if you're a seed fund and you're David Tisch today, he won't mind me calling him out, he explicitly does respectfully spray and pray. He does 50 plus companies plus in a portfolio with low ownership. But my word, he is in some of the biggest companies, including Ramp, consistently.
Again, going back to the Carta data, what I like about Carta is it's actual data, not words. There were 547 Series Bs in 2018. I'm going to guess. Graduation rate, probably, but that implies 800 A's. That probably implies 1,600 seeds. So even what you are pejoratively calling, quote unquote, spray and pray, is doing 50 deals out of 1,600. There's still a huge element of picking involved in that. The only people on the planet who have a structural business where they can de-emphasize picking because they can write checks, option checks at scale is Y Combinator because they have a structured advantage in terms of their economics. They are the only people who've built a mass production seed business. But for everyone else, if you're trying to pick even 50 and there's 1,600 places, right? I mean, and we know that at the B, only 500 of them get to the B. There are 1,100 places to put that money that doesn't work out. It'll always be true that if you pick the single largest outlier in any vintage, like if one of those deals was Figma, where the B made 100, so probably the A made, I can tell, about 200, and the C probably 400 or 500. I don't know, right? Of that order of magnitude, the numbers are available, 300, right? Even if it's 300, if you did an index and did every deal, you made a 300x and you did all 1,600 deals equally, it's only a 0.2. It's only a 0.2 return. Do you understand me? In other words, if you put $1 into everything, your Figma check doesn't, quote unquote, return the fund, right? If you did the whole industry, right? Now, maybe an OpenAI would. Maybe there is one deal so big that it would literally return the vintage such that if you just bought the entire vintage, you're good. That probably happens maybe once every decade or two, right? Most of the time, even at the seed stage, if there's not an element of picking to it, you can't just say it's brain, is my point. There's an element of picking up and down the stack. I mean, it's funny. I was more the Jason headline, only 1 in 3 deals double investors' money per Carta deal. It's so sobering. It's like, it makes you remember how much of this business is disappointment. You remember your deals, you remember your 10Xs and your 15Xs and your 20Xs, and you just forget, and I think actually the best investors and just learn to move.
Do you become numb to it, Rory?
I don't. I get all sad. I'm a bit lame.
I had a shit outcome this morning, and I'm really upset by it.
Yeah, you get vested.
Well, we can talk about that.
I had the worst, which is a company gets bought by another company, and you get stock at some insanely high price. I mean, it's just the worst.
That's not the worst. No, the worst. The worst is you're on the board. You try and sell the company. It doesn't close. You're on the hook for shutdown costs, and you have to wire 300 or 400 grand just to pay severance costs, which you should do as a board member, and you're probably legally obliged to do, and then write that money off straight away because you waited too long. That's the worst.
Wow, I thought my day was bad. That's perspective for you, kids.
That's why I just do everything on a safe. I have no rights, no visibility, no financial statements, no understanding of anything. But if it goes south, I can just ghost them.
Are you serious though, Jason?
What?
No.
About just doing everything on a safe?
No, but the safe does have some comforts. I do like the post-money cap as a seed investor. I don't have to worry about the pool or other things. And I like the fact that it's a medium commitment. I'm not the only guy. I don't always love being the only guy in the cap table, the only director. The safe is listen, I'm only sort of committing, guys. Good luck to you. If it goes great, I'll invest some more. If it doesn't, I'll write cheery responses to your monthly updates. But you didn't ask me to get married and commit, so I'm not committed. You think I'm joking, but the stuff Rory talks about is awful, right? This end of life stuff, or a decade of a struggling company where you're on the board. I'll take the safe over that. The unsafe safe, because the commitment is low back. Founders are, if you're going to raise in Saturday on a safe, you can't expect too much.
Speaking of commitment and marriage, I'm really intrigued to hear your thoughts on this one, Jason, because you've said I encourage founders to sell. I encourage founders to sell when the offer comes in.
So there's no regrets.
Synthesia, one of the hottest, fastest growing AI companies, now at 150 million in ARR, reportedly turned down a $3 billion offer from Adobe to be acquired. And they're going to be raising a new round at well north of 3 billion following this. Jason, if you were on the board, would you have told them sell for 3 billion?
I mean, yes. And I'm not saying it's the right decision, but one, he's been at it for a while. Synthesia is one of these stories Replit and Vercel that blew up with AI, but it's a journey, right? And there's competition, and it's a while. And I would tell him to take it unless you're 100% sure you're going to build a $20 billion public company, $10 billion public company. And if you are, do it. But I like to stress the test, right? So I'm not saying that's the right thing to do, but I want to be the guy that gives that advice.
10 or 20, because that's two different outcomes.
Even 10 is not really worth it for a founder. It is worth it for the VCs. Excel gets another play, right? 3 to 10 for Excel. Here's the issue, right? 3 to 10 for Excel, huge difference, right? So let's say they own 15% out of a what? $450 million fund? Who knows? Let's make it up, right? So instead of a 1x fund returner, it could be a 2 or 3x. You make that bet as a VC all day long, right? For the founder, let's say he owns 10%. What the hell's the difference? There's no difference, right? There's no difference, right? We've had billionaires on ours. You've had billionaires, Harry. I don't think Jeff Lawson would be living a better life with half the money or twice the money. It's the same dude. So like there is a weird disconnect between 3 and 10 here for VCs versus founders, because 1x your fund and 3x, that's a lot more carry.
So I would say with an Excel and index, you're absolutely right. They'll absolutely take the risk for another turn because they have the luxury of doing so. They don't need to return cash to LPs in the same way that maybe other managers do. If you are not a tier 1 GP though, you will want to provide DPI to your investors, especially.
I don't believe that. I don't see it. I've asked my LPs, I've asked a few others. If you're a strong manager, okay, if you have a track record and their goal is not a 3x seed fund, but if they really want 5x or north out of you, they get the game is you got to keep playing another card. No matter what they say, I've asked my LP, and I guess it's a small set, do you want more money back, right? Even asked my most conservative LP, like a university endowment that is small, right, that has stress. I asked, well, would you want your money back? I mean, with the gain, they're like, no, we're just telling you we're really worried about it. Like, we really want DPI, but we don't want it. We want you to play another card. So I think if you tell them, I seeded into Synthesia and we've got a chance to 3x it, they're going to tell you to go for it. That it's we're going to trust the fund manager's discretion here. I just don't know that there's this massive DPI pressure if you have a hot hand. I think there's DPI pressure if you have a mediocre hand, in which case, so what? Because it's not enough DPI. This is the other thing on X. What's the hell's the point of returning 0.2% of 20% of your fund? Hooray, I got an exit today. I returned 21% of my fund. Like, that ain't the full job, friends.
So the first question really should be, it's actually what Jason said is, Victor, I admire Synthesia enormously as a company. We tried to contact them. They didn't get back to me. They got the deal done. I'm so disappointed. We have another investment in the space. I love the space. I admire Synthesia a ton and many of the investors there. I think the first question is, how do you feel about the business? And you threw out a statistic there. They said they were at 100 million in ARR when they took the Adobe money in April. I checked, right? And if they really have gone from 100 to 150 in less than 6 months, then I can make this conversation really quick. There's no way they should sell because that thing's exploding, right? It's a great category.
It's a good point. And it probably is. That probably is.
I don't
think
know.
that's Sony baloney. That sounds right to me.
Even if not, even if they got, doubling kind of growth, it just feels like a good category. There's a reason we made another investment in the space. We liked the category. And I think there's runway there for that kind of human interface to compute. So I always tell the CEO, now would be a really good time for you, to look into your own heart and see how you feel, right? And if there's something about the business that's really worrying you and you haven't told us, now would be a good time to share, right? And sometimes stuff comes out.
The other reason I tell CEOs this, one, I would tell Victor to sell at $3 billion. And it's okay if he says no. I would do it because I wanted to be the guy. Yeah. Even if it wasn't in my direct interest as a gambler, I would tell. I want to be the guy that has that conversation with him. There's another thing that's under discussed, and I've had this conversation twice with founders in the last 12 to 18 months in similar situations. Is are you really an IPO guy? This is where there was one where I love everything about this company. I love the founders. I love everything. There's nothing negative. And I told them to take the offer, even though I didn't want them to as an investor. I told them to take the offer because they said, "Are you sure? You're such a great set of founders, but I don't know if today I see you living the what these public companies CEO life. Like, I just don't see it. The way you have to do it, the constraints, the stress. I just don't think that's what you want to do. So I think you should take the deal because I don't know if it's Synthesia or Synthesia Prime, you're going to get another offer like this before the IPO. That's the thing. You have to assume it's IPO or bust. And if you're not that guy, then you're going to bring in an outside CEO or it's just a mess. So that's the question I have. Do you really want to run a public company for real?
That's an excellent question, Jason. Genuine. That is really an excellent question. Because you're right. At $3 billion, there's not going to be a ton of people coming into view offering 5. You either got to become cash flow positive and settle down and just become the Collison brothers and compound private forever to universal befuddlement, or you got to go public. And yeah, it's a great question. And And the fact, by the way, that it is perceived by so many CEOs as a pain in the butt is, in my view, the thing about being public that has to change. Because what you're doing is you're allowing this thing to get in the way of people's entrepreneurial ambitions. I think I think you're right that it's a pain, and I think it's a shame that it's a pain, and I hope it changes.
I mean, I was at this Dreamforce Benioff dinner. It was great, and I saw maybe 10 public company B2B CEOs that we know that have all been on Harry's show, and Rory's invested in some of them. And it was great, and it was fun. I got some hugs. Believe it or not, I don't give the hugs, but I like to get them. Man, the stress on those guys, you could just smell it out of the pores. You know, the stress, or more the weight. They weren't stressed. No one's stressed, right? The weight of being a public. It's so heavy today, right? We could see it when we had Jeff Lawson on, and Cliff didn't have any of it at Canva. He didn't have any of the weight. It's crushing. It's just like crushing. And
I have Mike Cannon-Brooks on the show from Atlassian.
Yeah, some crushing weight there too. I saw it. Some crushing weight I saw on that one, right? You saw it, right?
Yeah, the weight of being the unreasonable man. Yeah, his co-founder calls him the unreasonable man, the guy who wills things into existence, and the weight of that you could see on his face.
Totally.
And when I look at the Ramp and the Mercor and the Stripes, like these are epic companies, right? But I don't see that weight yet. I'm not saying it's the hardest job in the world. Don't get me wrong, right? But I don't see the deep crow's feet and like, you know, Aaron Levy going from going gray at 28 or whatever. I just don't see that level of anvil level Wile E. Coyote weight on their heads yet.
That'll go to something about Andrew and capital efficiency. Rory, I just have to ask you said there about like, hey, we tried to get in contact with Synthesia, they didn't get in touch. I've learned over time, if you want to be in Andrew, the next best thing is just to pay the higher price for Andrew, not to try and be in the next one. You said you've got another player in the space. Why not just be in Synthesia? And do you not think this market takes the way most markets do in terms of composition, and the winner accrues the most value? I
do. I think it's a broad way. We have a very different product. It's kind of real-time interactivity versus asynchronous avatars. So there's a big difference in terms of the interaction. It's a company called Tavis. So basically, instead of pre-recording an avatar saying something or having an algorithm, you actually have real-time interactivity with the avatar, right? So it's at high level, it's the same conceptual trend. But I agree, because we looked at a Synthesia wannabe at the time. I'm not going to mention the name, and we decided Synthesia is one. You're not in the business of doing modest number twos. Agreed. So you're playing the broad trend in a different part, in a related but different market. I agree. You never want to do the number one wouldn't have me, I couldn't get into them, or they just raised a round. You either pay up for the later round. I made that mistake in 2013. I won't mention the two companies. You know, we had missed the rounds that were the typical scale round for company A. We actually had a chance with a lot of networking and to do a very late stage round in company A, or we could do a more normal scale round in company B, in exactly the same market, the two most head-to-head companies I've ever done. We did B, we got a 2X. We didn't do A, we left a 15X on the table. Literally every time we discuss this in the offside, one of my partners, I love them dearly. Oh, the canonical example has become that decision. And I'm like, am I going to hear about this till I die, people? Right? I know I got that one wrong, but they're right. They're right to mention it. That was you thunk true. Exactly. You never want to do the way behind exact same category number two if they're way behind. It's just too hard. Yes, I remember the week I got that learning. I can tell you exactly where I was when I took those two phone calls. Don't do that.
Okay. We can do Andrew capital efficiency. We can do Amazon layoffs. We can do Amazon cloud wars, or Oracle debt. You choose.
I feel bad for Roomba, but you choose.
Oh, you want to do Roomba?
Kind of it, because this whole talk is about how everything's up and to the right. Poor Roomba gets an offer from Amazon to buy them for $1.7 billion.
Yeah. And then go down the list if we've
blocked by antitrust. They raised $200 million of debt to finance the gap, and now it's all spent, and they're probably going to go bankrupt. This is why maybe take the Synthesia offer. Owning maybe a half dozen Roombas over the years, it's a tough end to founder journey, isn't it? But sorry, maybe that's not the story you wanted to pick. You go ahead.
Do you sue the government in that case?
No, I think in the UK it's called Crown Immune. It's hard. It's very. I mean, I can't remember because you can't sue I mean, in the UK, you have Crown immunity, where literally governments are protected from incredibly dumb acts because of the government. I think over here we have more rights, but still, and I'm winging it here now. Like, I can't remember, did they actually, if the DOJ blocks something on antitrust grounds, you can take them to court, and those DOJ decisions have been overturned. I can't remember in this case, did they take it to court or did they just decide to fold? And if you decided to fold, then you probably can't sue because you had a statutory remedy and you chose not to take it. I mean, so again, zooming out for people, the story here is iRumba had a deal to be sold to Amazon, and the FTC, led by LenaKhan, chose to block that deal because that's, I think Benedict Evans said in his plea, because of an insipid monopoly in the house vacuum cleaner marketplace. Very tongue-in-cheek, right? It was an absurd decision at the time, and it only got more absurd since, because unfortunately the poor company, which is a consumer hardware business with all the gross margin profile that requires, struggled on a standalone basis, and you right now faces the risk of going bust. It's a horrible and unfair outcome for which the government and LenaKhan and the FTC is entirely responsible based on an outdated, stupid and foolish paper. There's just nothing, and a foolish belief about how things work. Beyond
it's also another, I mean, there's the whole, how the antitrust killed the company. It's the edge of no politics rule, right, but not past it. It's also a reminder that, like, when you go into the M&A offer, the Synthesia, sometimes you'll get, like, the acquirer will pay a multiple that only sort of kind of makes sense, a revenue multiple that makes sense for them, but you couldn't get. And so, you know, when you get one of these deals, it's tragic it died, but you got to take it, right? You got to take it.
I don't know if you're a Synthesia, you're looking at Dylan and Figma going, God, do I want to put myself in that potential 18-month waiting period?
Exactly.
By which time I'll be 400 million in revenue being acquired for 3 billion. No.
You think you're getting this great multiple of, they're paying me 30 times revenue, but the damn thing's going to close in 18 months, by which time you might be down to 10 times, and it's just not going to feel that much. Like, I don't think Wiz has closed yet. I could be wrong. I think it was early 20...
That's the crazy one that hasn't closed. It's crazy,
and,
right?
Know, if you think about it, everyone's like, yeah, you got a 2.5x in 6 months. No, you didn't. You got a 2.5x in 2 years, right? And this prolonged antitrust process really is kind of sand in the gears for a lot of these M&A decisions, and at the margin probably pushes people to push on, either A, push on, or B, in the case of the crazy deals, when the acquirer only wants the people, then they do the Silicon Valley acqui-hire routine. But, you know, when you're buying the vacuum cleaner company, you want the frickin' vacuums. Right?
That duration period, though, is also why I think it's our responsibility as early stage managers to be much more proactive in secondary markets, because we get cash back way sooner. And the age-old thing of a 4x fund over 17 years is the same as a 2.5x fund over 10. And duration matters and time matters, and IRR is king.
It's not the only king, because obviously back to Jason's comment. He was just sneering at because look, in this very show, Jason was going, it's only a 30% IRR ramp from the 22 billion to 30 billion. From an IRR perspective, that looks amazing. So I don't think IRR matters. I actually think, for the record, formulation of the optimization function is the maximization of multiple subject to a constraint on a minimum IRR. Just to be a total geek here. Basically, you should know what your target IRR is, and let's just say it's 25%, let's just say, right? You want to maximize the multiple, provided you don't dip below 25. Right? That's actually what you're trying to do, right? So for example, a 30% IRR in 1 year isn't as good as a 25% IRR for 4 years, but if you hold on too long and that 25 starts dipping to 19, 18, 17, then you've gone to a different place. That is the rule, right? Because in the end, you want the maximum amount of capital to invest. And you get that because you are held accountable at the investor level at the IRR basis, because at some point they're looking at you, they're looking at the public markets, and they're saying, risk adjusted, I need me my 20%. So it is the constraint because it's what prevents money from coming down the spigot to you. But you're actually trying to maximize your multiple.
So the shit is hitting the fan at Amazon before we do agree or disagree. 10% largest layoffs in history. 10% of white collar, that is. That very sizable. Falling behind in cloud wars from 50% of cloud revenues in 2018 to 38% today. Raymond James sees Amazon's AI cloud share falling to 7%. Then we had the outage, billions of damage. I mean, this was a bad fortnight.
You know what? Maybe it's not fair, but what I was thinking is contrast this with Sergey Brin coming back to Google, everything else happening. Maybe this was a tough time for your founder to leave and go to Miami. Maybe this was not, maybe it seemed like a very stable time to do a transition, right? I mean, Jeff Bezos, long time as CEO, but maybe this wasn't the perfect age of it. Maybe stepping down just before AI hit was suboptimal for Amazon.
Or yes, or maybe it was brilliant for Jeff, because maybe because you're implying in that had he stayed, all these bad things wouldn't have happened, and it's plausible just given his world top 2 or 3 entrepreneurial achievement of the last 3 decades. But it's just worth pointing out what the 2 big problems they have are. The first problem is in their retail business. They overinvested for COVID, and now they're trying to replace people with robotics because the technology is there, and that's just something that had to be done. Right? That's just more of the same. And in cloud, it's less that their core AWS business has folded up. It's like all the new compute, which is 10x and 20x larger in terms of demand for these customers, is AI-related compute, and you've neither built something compelling standalone nor have you partnered, except, to be fair, a little bit with Anthropic. You didn't make a meaningful partnership, and you haven't found a way to get some of that compute, right? Not clear.
But he had 4 years. Andrew Jassy took over in July
Agreed.
5th, 2021. No. Bezos checked out right at the peak of the last era, when products were frozen in time for a decade, when AWS was the same product for a year. So are most of the companies we invested in, all 3 of us, in 2021. They were the same products as 2015. Totally. It was the great time to go to Miami because nothing was changing in the world. It was just stock prices were going up in revenue, but the products were the same. So why wouldn't you retire? There's not going to be any change.
Punched out at the top. No, it gets an A++ for market timing.
No, I think he gets an F.
Oh God!
If he sold his company, you get an A+.
That's true.
But like my last deal, Saleloft, December 2021. $2.5 billion. That was the last deal of the era. Kyle and team get an A+ for timing. This is not the same.
I want to congratulate Kyle. Exactly. This is not
the same. This is punching out at 2021 and not punching back in like Sergey.
Cynical comment here, you're right. But when you've got a couple of $100 billion, my guess is you're not maximizing money, you're maxing psychic pain and joy. My guess is his psychic joy in the last 3 or 4 years doing what he's been doing has been significantly higher than the psychic pain that would have been involved in realizing you've never done a big acquisition in your life, you've got to do a huge corporate deal in AI to matter, and B, all those people you hired in 21 trying to do the right thing for COVID and expand, you all got to lay them off. So I don't think it would.
I think Bezos would lay off half his company in a fortnight if it was the right thing. I don't think he even care.
Well, he'll have that chance. He's, But again,
Chegg had to bring in poor Dan Rosenwig out of retirement to rerun Chegg after laying off 80% of the company. They had to bring him back. They got to bring Bezos back.
I think, and to be fair, one thing we shouldn't do here, and you saw a lot of it with Google too, is that you don't want to overcompensate. I mean, if you look at the two, if you kind of there's a bunch of bad news in one day, and it is bad, right? But a lot going on the layouts, right? But again, going back to your position in retail is broadly good. You're a little, I think you've become a little schlocky in terms of the shopping experience, but you have dominance because of your distribution, and you're doubling down on that. You're reinvesting in robotics. You're cutting costs. And Amazon wins in their retail business because they can deliver shit faster than anyone else on the planet pretty much anywhere. And you're doubling down on that. So that's like a win. On the compute business, on the AWS business, your problem is you're not relevant in the new world. So just knuckle down and figure that out. To be fair, of the 3 hyperscalers in the pre-AI world, if you look at it, Google was able to be relevant because they had their own model. Microsoft went and rented a model from OpenAI, and now the contract's nearly up, and they did it to make a lot of capital gain, but they didn't actually, in my view, really develop something compelling that they own from it, and you did nothing. So you lose. You need to do something. They got a set of problems on the AWS side, they have to get AI relevant without, frankly, doing what Oracle, I fear, is doing, which is taking on a whole bunch of subpar economic transactions. They do have a good slug of Anthropic, not as much as Google, who I think owns 14%.
Google owns 14% of Anthropic.
Google, yes, Google win. Yeah. I mean, again, we should be promoting all these corp dev guys. They're doing great.
Unbelievable. I think people forget that. Guys, we're going to do agree or disagree. Okay, I got 3 statements. Rory, you love this. Come on, you can hide your excitement, Rory. It's too much.
Just pulling shit out of your ass. I hate it.
No, I know. On the previous hour and a half wasn't.
I do research, Harry. That's the difference between us.
Ah, dear. Yeah, it's a very fair point. I can't disagree with this. Okay, first one. I would rather own Brex at 13 than Ramp at 30. Ramp is at $1 billion in revenue. Brex is at 700. They're both around the break-even to moving profitable phase.
And you've given me all the information except the only information I need, which is what's the growth rate.
Brex said 50%. They just said they're going 50% now. I don't know what Ramp is. This is where my cognitive bias.
Yeah.
I'm going to go for Brex because it's lower. I can't help myself. I cannot help myself. I can't help myself. For real. You think I'm kidding? I can't help myself. If you gave me, I don't have that much money to invest. If you gave me a great deal at 100, if you gave me Ramp at 100 million and Brex at 30 or 40, I'm still going to do Brex probably.
I could assign a homework assignment that would make this actually an interesting discussion. We have all the data points we need. We have the relative size, the valuation, and the growth rate of Brex, right, at 50%. The correct question is, what growth rate should Ramp have such that you're indifferent between those two prices? In other words, if Ramp is at 100, you probably want Ramp. If Ramp is at 50, you definitely want Brex. It's actually the fundamental question I would argue in all of venture is how much extra do you pay for how much extra growth? If you could buy Ramp at whatever it is, 700 billion going 50% for 13 billion, 700 million, 50% going at 13, break even.
That's Brex.
And Ramp, 1 billion at 30 billion, there is an equilibrium growth rate that would make you indifferent between those two prices. And it's actually a very fun exercise because it actually is the core problem you face over and over again in venture, which is how much extra do you pay for 70% growth over 60 over 50? You pay almost 2 to 2.5 times the revenue multiple. How much more growth would you want from that? I'm missing 700.
This is your job on the show, Rory. You got to tell me.
Yeah, no. It's hard to think and talk at the same time. Keep going.
You weren't relying on us for analysis, were you, Rory?
It's Sharkara, yeah, I was. Keep going.
Come on. Okay. Andreessen deserves the prize for best performing mega platform of the last 12 months.
They're going to get the prize no matter what I say. It doesn't matter. They're getting the 10 billion. That's prize enough for those guys. They'll be fine.
I've been impressed by them. I've invested with them across the board. And I think one thing that people often say about Andreessen, with absolute respect to them, is they have so many people, and that almost suggests that they can't all be good. They have so many people, so like whatever. I have worked across the board with the different partners. They are as good as the partners at smaller firms with 3 to 5 partners, and they've been fantastic. Like I'm a big bull on Andreessen now, where I was not before.
I agree. They've been operationally excellent. I mean, what they did is I've been thinking about what they brought to the venture business from 2007, 8 on is they went into it solving the problem from the founder back with operational excellence, right? And on that, they've delivered in spades. They figured out what the founder wants. They've aggregated and delivered to him. I've always said the question always is, the return profile of that has been excellent. I mean, I've seen the numbers; they've been excellent. And the question that was the question, and they pulled it off, right? And I agree with you on the human capital thing. And that's why I think it's smart the way they have. I mean, obviously they've just lost. I can never pronounce the German name, Andre, but very impressive. I've heard him speak. Who's going to do his own thing?
Mitte. Yeah.
I mean, super talented guy. I heard him speak. I'm very impressed. They have a constant churn, and I was thinking even that's okay. Because they have a platform that transcends. They'll find other good people. They'll have they have the little pockets to play with, so they can give you your little info world. They can give you Chris his crypto world. Everybody can have their thing. It's just like investment banks, where you're the second co-head of North America. Everyone's got a great title, and Mark and Ben sit at the top, and life is good. It's a well functioning scale machine, and the take 15 years ago was venture couldn't scale, and it's TBD how far it can scale, but they've scaled it far more than anyone else would have thought 10 years ago, and for that they get a price.
When we sit and look at Series A, we don't sit and be frightened by Index or Excel or the big European players. We sit and be frightened of Andreessen coming into Europe. They're the ones who beat you.
Okay, good to know.
Well, look, I think you want to be in the top 2 choices for a founder at your stage. That's when you win in venture. It'd be nice if you're in every stage and every deal, right? And I think Andreessen has elements of that today. A top 2 choice in so many stages from so many types of founders. YC has that in a sliver, as do others. If you're not, man, it's just a different game than when you're a top 2 choice. It's just a different game. That's what you want. So I agree with you. There's only 2 people can be in the top 2, right?
Final one. Of all the could be public but are private late stage companies, I would rather be a shareholder today in Andreessen, the hottest at 50. Agree or disagree? And if disagree, which would you rather?
No, one, not interested in the company personally. Just personally, at this point in life, I just want to do things I'm interested in to a fault. Not interested in building weapons and stuff like that. Just not my vibe. 2, I don't go to enough parties in SF. Because if I did, and this sounds facetious, but you know what, I'm joking. I'm never really fully joking is where it does. There's no better brag at a party than Andreessen that you did it, right? It's the ultimate founders fun brag. It's just the ultimate brag. And one of the psychic benefits of investing is bragging, right? At many levels, there's different types of bragging. There's bragging because I have a sense of worth in my life that I don't. I'm bragging because I wrote a tiny check, but I'm validated in my soulless job. There's so many levels of validation, but I just don't go to enough of those parties since 2020. So, but if I did, I'd want to have that one on my chips to talk about at parties, but I don't care, and I'm not into bombs and weapons, so I'm out on this one.
The amount of self-knowledge embodied in that last 2 minutes from Jason is just stunning. I mean, the therapy's clearly working, dude. Right? Well done.
It's just called being happier.
I think it's actually called getting older and wiser. I love it.
Maybe.
Yeah.
Listen, guys, on that incredibly hearty note, thank you. This has been fantastic, and I've loved it.
All right. Rock and roll. Thank you, Harry. Thank you, Rory.
Thank you.